This is the chart to be looking at if you want to know where this market is going, because right now we are stuck in a neutral range and we might be stuck here for a little while. So what you want to wait for, because things are uncertain, you want to wait for price to tip its hand. If the market moves above this 44.70 line and not only moves above it but closes above it, then we open up to possibly new highs in the market. But if it closes below 42.80, then we open ourselves up to a down move to 4,000, right, which is this line right here, and that would complete the correction that we've been expecting. And you can see, like today, the market barely moved, and this is what we're going to expect if it keeps going sideways. Something needs to happen. So you won't really know whether you should be long or short. In our case, we're hedging and playing both sides and then waiting, like I said, for the tape to tip its hand. And as always, this research is coming from Macro Ops, our global macro research and consulting firm. If you're not on that email list over there, you should be. Now, given where the market is right now, we have two scenarios. The thing can come back and we can hit new highs before we get that 10 to 20% correction that we've been talking about, or it could happen right now. Again, we can't know for sure because we can't predict the future. We can only play the probabilities. So we really got to wait and see what happens here. But one positive for the bulls is that we now have positive seasonal tailwinds after passing the dip in seasonal weakness on the 9th. So you can see this is the bottom of the seasonality right here, and now we're clear. So that raises the probability that we actually break to new highs. But on the other hand, we do have elevated valuations with a Fed that's looking to be abandoning fate. And remember, this was the inflation targeting that they were doing, and it was the one where they decided to, hey, we're going to let the economy run hot and actually support it even more so it could run even hotter, and we're not too worried about inflation because we really want to bring unemployment down. But as we explained last week, the Fed has kind of reversed on that already. Surprise, surprise, because inflation has been looking bad and they got spooked. So now they're looking to raise rates earlier than what the market was expecting, which is part of why we've had this big down move. Now, as inflation continues to prove less transient than what they were thinking, then you're going to get more volatility as they look at raising rates faster. And if inflation stays elevated like it is, then we should expect to see valuations continue to contract. As you can see here from this chart, that's usually what happens historically. But as Macro Lucas recently pointed out, we're probably near the peak supply chain hysterics. You've been seeing supply chain news everywhere. Here are just a few examples. The Economist, Barron's. And the way it works is when every magazine has it on their front page, it's usually already priced in because the media is always slow on the narrative. So the normalization on that front will help slow the rise in CPI, so slow inflation. Another thing we're watching is cyclical versus defensive stocks right here. So new relative highs would be a bullish tell for the broader market. And this is cyclical versus defensive, right? So if it's going up, that means that cyclical stocks are doing better than defensive stocks. FANG stocks are actually trading at their lowest premium to the broader market since the 2018 bear market low. So Google, Microsoft, Apple, they've all seen a nice pullback and reversals at their weekly Bollinger Band midlines. So might be some good opportunities to get in those big stocks. Crypto charts are looking solid again and are acting as a lead for the broader market. Bitcoin open interest is finally perking up after trending down for the last year, and this is indicative of big money interest returning to Bitcoin. And that bodes well for the sustainability of this bull move. Risk taking is good for a bull market, at least until it becomes too much risk taking. Another thing we're watching is semiconductors. The breadth keeps deteriorating there, which typically leads to a broader risk off in the market. So we got to see if the semiconductor index can hold its 200-day moving average. So yeah, as you've seen, there are a lot of mixed signals out there, which is why one of the best signals is just price. The market is going to tell us what it's going to do because everything we talk about gets boiled down straight into price. Does it go up or does it go down? So just remember to keep your eye on these two lines. We'll see where the market breaks out to. Or if you don't want to watch the market at all and you want to automate this whole thing so you don't have to worry about it, which is exactly what I do, check out our free training here on how we do that. I'll put a link to it in this video and down below in the description and comments. It'll show you exactly how our system works and why we don't need to stare at all this stuff all day. So definitely click the link to get into that training, and I will see you there.